the big question in the industry is like, what do you pay for property management companies, or what are people paying for property management companies? Before I answer that, I want to talk about, like different ways of looking at it, because everybody looks at it a little bit differently. There is like a revenue multiple, which is pretty easy, right? Like, what's the top line number that they're bringing in? There is like an NOI, net operating income, or EBITDA multiple that is, basically what money comes down to the bottom before EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And those are kind of like the two ways to do it. There's also the third way would be like a number per unit. In other words, hey, what are you paying per contract that you're buying? The way we look at it, mostly the way we think about, let me tell you just the way we think about this. We think that the smaller companies, and when I say smaller, forgive me, I'm not trying to be offensive, but when they're below $1 million, EBITDA is very hard for us to determine, right? Because there's things like maybe somebody's got their truck or their insurance, or there's all sorts of things. And I know you can do things like add backs, but there's also this conflict of, well, if that person that was running that company, that generally is the brains behind the business, gets hit by a truck, what is it going to cost to replace them? And so what we would say is that's what true EBITDA is if that business was a standalone, what's that? What kind of revenues that, what kind of EBITDA is that company generating? So instead of arguing over getting hit by a truck and saying all that, we think of it as more of a revenue multiple. And the reason we think about that is because the way we run our operations is, and this gets back to why we acquire people that want to get out of the business, is we will buy people that want to get out because we know we're going to take their revenue and put our expenses underneath it. Now, there are some things that happen that we need to be aware of. So it's not like we just like toss all the expenses out. But what we know is if this has this many homes, we know exactly what it's going to take for us to run that business. And so when Josh comes to investment committee, he's already prepared for that. And so what we do is we say, here's the revenue that we're getting. And then Josh basically builds in, what is it going to be under Evernest? If this is a new platform acquisition, are we going to have to, either take over the rent or plan on rent? Are we going to need somebody to run that market? How many property managers? How many what we call ITMs, which is international team members? We go through the whole gambit, and Josh breaks that down, and then we kind of have this form that we fill out. And then what we do is we convert that into a EBITDA multiple, and then that's how we view it on the back end because of the way we pay for these things now. Now, listen, when I first got into this business, if you're thinking about buying your first business, I could do most of the calculations on a napkin. And look, it's okay to do it that way because if it gets overly complicated, it's probably not something you should do. And so just know that, look, doing it on the back of a napkin is probably not a bad thing to do. But Josh, question on, what does the industry say is standard for these companies these days?
Yeah. So there is there's kind of a universal band, if you will, both on the top end and the bottom end. So the revenue and then the EBITDA or your net profitability multiple. The amount that people are willing to pay per door is really an output of kind of that calculation. So I wouldn't get into that, but typically all of the deals that are done happen on the revenue multiple side, somewhere between 1 and 1.5 times revenue. Few happen all the way up to 1.5. Most are kind of closer to that 1.2 threshold. But if you think back to what we were talking about before, and I would say 80% of companies probably sell within that 1 to 1.5. The other 20% may be lower or maybe a little bit higher than that. So, I mean, there's no like universal guarantee, but that's where the overwhelming majority of these deals wind up falling. And you'll hear that if you listen to other people that host these webinars and that sort of thing, you'll hear that same recurring theme. It's a pretty industry standard. But if you have $1 million revenue business, there's a big difference in $1 million and $1.5 million. I mean, at least for me, right? I mean, it would be if I were looking to sell my business. And so, what is that sliding scaling? How does that impact that? And what we were just talking about, those qualitative variables, is it strategically important to us? Is it do you have high Google ratings? Have you been in business for a long time? Or are you a fly by night operation that was there for a year and now you're just looking to get out? Are you well diversified? Are you well diversified with your owners? And are you consolidated geographically? I remember, and a lot of you won't be familiar with maybe with this territory reference, but one of the first deals that we looked at the beginning of last year was in Birmingham, but the portfolio was split roughly half in Birmingham and half in Montgomery. Well, Montgomery is about an hour and a half south of Birmingham, and we didn't have an office in Montgomery. And so that deal didn't make a lot of sense for us because we would have been scattered over an hour and a half drive time for our managers and for our technicians. And so those types of things do matter. And so as we go through and we qualify these other parts, that is where this sliding scale comes into. Are you truly a great business? And if you're truly a great business, then you can expect that lever to slide up. And then on the net profitability, typically you're seeing somewhere between 3 and 5 times. But if you think about it, it's usually going to be, again, kind of two sides of the same coin. Those numbers almost always even out. So if you're talking to somebody and they say, oh, well, we'll pay you, 2 to 6 times or 3 to 5 times your EBITDA, that number usually winds up being identical to that same 1 to 1.5 times top line revenue. If you are less profitable, if your net profit is below industry standard, it may sound great to be like, oh, I got a 10 times multiple. But that may just be a story because you weren't very profitable. But if you would have been industry standard profitability, it would have only been 3 to 5 times multiple. So typically what we see though is top line 1 to 1.5 and then the bottom line somewhere between 3 and 5.
Let me add one more variable to this that we hadn't discussed yet, and that is risk, right? If we've talked about what the list of things that we look for to help evaluate qualitatively the risk, but there's also terms of the deal. And if you think about it from a standpoint of who is assuming the risk of attrition? If in this case, if Evernest assumes the risk of attrition, then we're going to pay less, right? Because we're going to account for some inevitable attrition that's going to happen. But if you're willing to take on more, if the seller is willing to take on more, we're willing to pay more or have the potential to pay more because they're removing the risk. And really, we think about that in 2 buckets. One, we kind of have talked about is around some sort of attrition clause or clawback, meaning if I lose these houses, then you're going to give me this money back. And if I'm buying it, I'm either going to set that money up in escrow or maybe I call it like a second, maybe some sort of loan that gets forgiven if those homes leave. The second piece of this is we like to use owner finance, seller finance. And so if the seller takes on the risk of financing the opportunity for us, we're willing to pay more money there because they're doing us a favor, right? Like we don't have to go to the bank or we don't have to go to investors to get that capital to buy that business. And as you build a brand, as you build a reputation in the industry, you can get more and more seller finance just because people know who you are, they trust you, and a lot of the time sellers don't necessarily trust the stock market. They don't know what they're going to do if they got $1 million check. But this allows them to, earn some sort of interest rate on their money.